18 months to reposition, 4 assets that survive debt collapse. 18 months is the window to reposition a portfolio before a major transfer of wealth occurs. Long-term debt cycles accumulate over decades. When the cycle peaks, conventional portfolios can lose 50 to 60%. Central banks typically respond with monetary accommodation that produces inflation, which favors debtors and tangible assets while crushing savers and fixed nominal claims. How the system breaks: the economy runs on productivity growth, short-term debt cycles, and a long-term debt cycle. When accumulated debt becomes unsustainable, options are defaults, restructuring, or inflation. Inflation is the usual policy response: debts are devalued, but real purchasing power of savings is destroyed. Rising interest costs amplify the problem, and small rate moves can sharply devalue outstanding bonds, forcing more money creation. 4 resilient asset classes. Physical precious metals, gold and silver held in your possession, are insurance against monetary collapse. They have preserved purchasing power across past inflationary episodes and act as a non-counterparty store of value. A modest allocation, 10 to 15% of liquid net worth, in allocated bullion or secure vault storage is recommended. Businesses with pricing power, firms that produce essentials or control scarce inputs, can raise prices and protect real margins. Select individual companies with durable brands, hard assets, predictable cash flow, and conservative payout ratios. Allocate roughly 30 to 35% to a diversified set of such businesses. Short-term government securities and cash equivalents, maintain liquidity, 20 to 25%, in 90-day to 2-year Treasury bills or Treasury-backed money market funds to preserve capital, earn current yields, and retain optionality to buy distressed assets in a crisis. Productive real assets, income-producing tangible assets, agricultural land, rental properties, infrastructure, generate essential goods and services. They are scarce and produce cash flow that typically keeps pace with inflation. Allocate about 10 to 15% via direct ownership or diversified rights/farmland funds. Implementation framework. Timeline and pacing: determine how soon you'll need the funds. Reposition gradually if time allows, move faster when nearer retirement. Sell speculative or highly leveraged holdings first. Trim concentrated equity positions systematically over months rather than trying to time a perfect exit. Build the 4 buckets incrementally: start small, average into positions, and increase allocations over several months to reduce emotional risk. Maintain a small tactical sleeve, 10 to 30%, for higher risk opportunities suited to your expertise. Behavioral rules: ignore short-term noise and headline chasing. Use a rules-based plan with deadlines and concrete targets. Evaluate each holding by one question: will this preserve purchasing power in an inflationary debt crisis? If not, plan its replacement. Final note: historical patterns recur. Paper claims and long nominal bonds are vulnerable. Assets that produce real goods, have pricing power, hold intrinsic value, or sit outside the banking system preserve wealth. Act now to rebalance toward resilience before the window closes.